Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. Let's take a look at the stories for the day. India has announced a $10 billion incentive plan to woo global chip makers. But will the semiconductor and display manufacturers walk down the red carpet rolled out by the government and set up factories here? This report looks at the infrastructure demands of chip makers and the challenges India faces in realizing its dreams of being a player in the semiconductor space.
India is now the world's biggest smartphone manufacturer after China. And in its next step to make the country a global hub for electronics production, the government has approved a $10 billion incentive package to semiconductor and display manufacturers. The government announced it will provide support of up to 50% of the project cost to eligible companies. The center also said it will work closely with state governments to provide the right infrastructure for fabrication plants. India currently imports 100% of its semiconductors, spending about $24 billion annually. Now, the plan is to make India self-sufficient in production of semiconductor chips that go into phones, computers, cars, and everyday electronics such as washing machines, TVs, and refrigerators. It all comes at a time when tech companies and automakers around the world are grappling with chip shortages. Despite strong demand, Indian car makers are estimated to lose sales of 5 lakh units in FY22 due to chip shortage, according to ICRA. Ironically, India is a leading chip designer with 25,000 engineers working in this field. Our semiconductor design market was worth more than $33 billion in 2020. The new incentive package includes support to homegrown chip product design companies. The semiconductor industry is an extremely concentrated one, both in terms of companies and the countries. Just top 3 companies, Intel, Samsung, and TSMC, made $188 billion in revenue in 2020, as much as the next 12 largest chip makers combined. When it comes to the foundry business, TSMC's home country Taiwan alone accounted for 63% of the total global foundry market share in 2020, followed by South Korea at 18% and China at 6%. The chip supply crisis that began after the pandemic highlighted our reliance on Taiwan and China. Geopolitical factors are also pushing India to reduce its dependence on Beijing. While the domestic opportunity is huge, making semiconductors is a complex process. It takes hundreds of precisely controlled steps over several months to make a chip. Qualcomm India President Rajan Vagadia gives us a sense of the complexities behind setting up a fabrication unit.
The market is huge, the opportunities are huge. I would say when we look at the fab and we look at it as not one activity, which is the fab itself. There are quite a few things that come before the fab and after the fab. So it's actually a set of activities, and the fab happens to be one of the activities. I think the market is perfectly there for India. Now, if you pick up that one piece, which is called the fab, you need a lot of infrastructure requirements, which are very stringent. I would say we need also that infrastructure to be in place where it's not just about land, it's about power, stable power. It's about availability of inert gases, availability of chemicals, availability of right transport. I would say we need to look at all of those aspects and then take a conscious call as a country where you want to start. You can start anywhere. Every piece has its own nuances. And as far as we want to look at the nuances and take a responsible call on it, that's perfectly fine. If you were to ask me personally, I would say the R&D of the semiconductor is probably more key to start with.
India's previous attempts to attract chip makers in 2017 and 2020 had failed. In 2007, Intel had shown interest but moved to China and Vietnam instead because the government's policy in India and incentives were not thought through. In 2013, the government approved 2 proposals by JP Group and HSMC with a promise to subsidize the project cost, but the projects failed to take off as they could not attract investors. We spoke with Rajiv Kushu, Chairman of India Electronics and Semiconductor Association, to understand what impact the new scheme will have.
The whole story started way back in 2012, 11-12 time frame, and there were a lot of incentives and packages given at that point of time, but none of them were basically comprehensive. You see, this policy does not leave any loopholes. It covers design, it covers manufacturing of semiconductors, it covers even packaging of semiconductors. I won't be surprised within a month there will be announcements of at least 2 semiconductor fabs and 2 display fabs. So incentive definitely plays an important role. But apart from that, there are other things which play an important role, which is power, infrastructure, and proximity to the airport. And what is important here, whenever you have a semiconductor fab in the country or an OSAT in the factory, OSAT in the country, it does not see India only as a market. It sees the global market. So you need to have really quick turnaround time. See, those are important things, but you must appreciate in last since 2012, there has been a huge investment in the number of airports we have in the country, in the number of highways we have. So I think we are much better equipped today compared to 10 years back in terms of the infrastructure, water, the availability of water, and availability of the road infrastructure, and talent as well.
It takes years and costs upwards of $5 billion to set up a fabrication unit. Factories of companies like Samsung and TSMC cost over $20 billion each. They require continuous power supply as they run 24/7. Moreover, an entry-level factory consumes more than 20 million liters of ultra-pure water per day. Chip manufacturing companies require a pollution-free environment and very clean rooms. Even a single speck of dust can compromise a chip, costing millions of dollars. India can find early success in outsourced semiconductor assembly and testing, or OSAT. An OSAT plant packages, assembles and tests foundry-made silicon wafers. This is what the Tata Group is reportedly planning to set up at a cost of $300 million. To establish autonomy in the entire semiconductor value chain, which includes designing, fabrication and testing and assembly, India must promise the right infrastructure apart from the financial incentives. It will take a lot of effort, like finding the right spots for factories and coordination with states for uninterrupted water and power supply.
As India looks to woo global chip makers, companies back home are busy doing their bit to boost the country's economy. With the initial fear about the new COVID-19 variant seemingly waning, the IT companies appear to be forging ahead with a back-to-office plan. And if the Omicron doesn't turn into a deadly strain like Delta, there will probably be no looking back. Our next report offers a peek into Indian IT industry's roadmap to reopening their offices.
As the Omicron spread its tentacles beyond southern Africa, the World Health Organization sounded an alarm. It said the new strain was a variant of concern. But later, health experts in South Africa, where the variant was first detected, said that patients have shown mild symptoms and most of them didn't even need hospitalization. So as the initial worries faded and markets started gaining ground, the IT companies in India refused to put a brake on their back-to-office plan. But all the precautionary measures are still in place. Most companies are continuing with their policy of banning overseas trips and allowing only essential travel within India for executives. In the middle of a staggered opening, India's top IT firms are placing greater emphasis on precautionary measures such as vaccination, social distancing, masking, and sanitization. Almost all the companies have got their employees vaccinated, and they are continuing with a hybrid work model, calling a portion of their staff to office while allowing others to work from home. About 20% of Tech Mahindra's staff is back in office, and a section of employees of HCL Technologies are back too. Having said that, the trend of hybrid work is set to continue. This is when employees visit the office on some days and work from home on the rest. We spoke with Lohit Bhatia, President of Workforce Management at Guess Corp, to understand the industry's outlook towards bringing employees back to office.
I think, what has happened is that Omicron is still fairly new when we are talking about it. In fact, it is just about, say about 2 weeks that the world has possibly realized it and spoken about it. Whereas the back to work is something which is now a concept left only for the IT industry. But if you actually ask majority of the employers today, they'll tell you they have anywhere between 40 to 50% of the workforce showing up to work. While there's so much written about IT, IT is not the only industry which, has offices across the country. Everybody else, whether it's BFSI and all, they're all working from office on few days at least, if not all the 5 days. Yeah, so IT had two principal announcements. A bunch of MNC IT companies had clearly articulated that they will open from the fourth quarter, which is January 1st onwards. That's after the New Year's. And I think they stay put. They haven't made any change whatsoever so far. What they're very clearly asking is that every employee who comes to work has to be fully vaccinated. Few IT companies had already said that they'll open after Diwali, which was on 15th of November. But we haven't heard any, movement back to locking down in any which ways or, not allowing people to come to work and rather encouraging them to work from home. That's not happening in this round. We're also going through something called the Great Resignation. Let's also be cognizant of the fact that 18 months of not meeting your teams, not having a face-to-face contact, not getting a human touch with the people and all is also leading to some breakdown of that element. I think IT companies have realized that had there not been such a long lockdown and everybody not working from home, opportunities aside, and I'm not saying people are not moving because there are opportunities and better compensations being thrown by the potential employer, but I think lot lesser attrition would have taken place. And that is the other reason why they'll have no choice but to come back to work.
Kamal Karant, the co-founder of specialist staffing company Xfino, also concurs with that assertion.
In the wake of Omicron, we're not seeing anything changing as of coming back to office is concerned. Most of the IT organizations are still talking about January as the return to office. Albeit it's more a hybrid mode that they have announced right now, which as you know is about 2 or 3 days depending on the organization that we're talking about. So nothing has changed, and most of the organizations have also stated that they're going to observe next 2 weeks as to how things are going to be and then possibly take the call.
A reason companies are not willing to once again go back to a permanent work from home model is because they believe it will make it harder to preserve company culture. Apart from this, all of India's industries, including manufacturing, retail, entertainment, have completely opened up. With schools slowly opening up in several states, employees with children are also willing to work from offices. More importantly, after 18 months of working from home during the pandemic, employees, especially freshers, are keen on a change of scene. This in turn has bolstered companies to go ahead with a phased return of the office workforce. All said, back to office plans are not something that can be implemented in a day. Rather, it is a process that will take months, starting with a hybrid work model. Companies will now consider their plans only if COVID-19 turns into a serious threat again, mandating a lockdown.
Not just Omicron, Indian markets appeared unperturbed by the upheavals in the US economy too. The US Federal Reserve has signaled a hawkish stance in the coming years while keeping the policy rates unchanged for now. But even as the outcome boosted risk sentiment across the globe, Indian equities failed to mirror the sentiment amid insistent FPI selling. The near-term outlook remains uncertain as rate hikes by developed countries may aggravate the outflow of foreign capital. Our next report captures what the US Fed's policy means for India and where the benchmarks are headed.
Dalal Street indices egged out marginal gains yesterday, even as the outcome of the US Federal Reserve boosted risk sentiment globally. Under normal circumstances, a larger taper and 3 rate hikes of 25 basis points each in 2022 would have been considered negative from the market perspective. However, world stocks rose on Thursday as the US Federal Reserve expects inflation to gradually cool off. This, Fed Chair Jerome Powell said, would enable a slower liftoff in policy rate to 1.6% by the end of 2023 and 2.1% by the end of 2024. Yet, as the rates will stay below the level of 2.5%, which is considered a neutral level by the Fed policy was positive for equities. Commenting on the outcome, Mohit Ralhan, Managing Partner and Chief Investment Officer at TIW Private Equity, said the Fed's commentary on inflation has made the start of a tapering a foregone conclusion. Listen in.
The shift in the commentary on inflation from being transitory to being persistent has made the start of tapering a foregone conclusion. The acceleration of tapering indicates that the Fed is playing catch up to inflation, and at the same time, it also indicates that the policymakers are comfortable with the sustainability and projections of economic growth.
That said, rate hikes by the world's biggest economy would also mean an outbound flight of capital from emerging markets, including India. And this may keep the Indian equities under pressure in the near term. On Thursday too, the Sensex and the Nifty opened nearly 1% higher amid a firm global setup, but they ended flat amid persistent FPI selling. Let's go to Gaurang Shah, Senior Vice President at GeoG Financial Services, to know the near-term market trajectory.
Basically, the selling from FIs have been unabated for some time. And that is primarily the reason why you are seeing these kind of moves on the market. And lack of triggers in form of any positive gravity in terms of local or global markets. And moreover, we had the Fed meet. They have done what they had to do, and the outcome is known to us. So up until yesterday, I think there was a little bit of concern as to what Fed is going to do. But now that this is done and dusted, I think we should trade in a narrow range, both on the Sensex and Nifty. And we will spend this entire year over here. I don't think we are going to go anywhere. I think 17,000 or thereabouts on the Nifty spot could be the floor in the near term. And 57,000 on the Sensex could be the floor, wherein we'll go there and bounce back. A bounce back could be 58,000, 58,500 on the Sensex from the lows that I mentioned. And maybe about 17,500 or thereabouts on the Nifty. So we will trade in a range, and I think it is good that we are spending this. Consolidation is happening at this level. The next move, I think, should be durable once we make a base over here.
Mohit Ralhan of TIWPE expresses similar views and says Indian markets have been witnessing a downward pressure in anticipation that the Fed's policy may lead to a decrease in liquidity.
As far as Indian markets are concerned, it has been witnessing a downward pressure in anticipation of Fed's policy decisions, as there is likely to be a decrease in liquidity, which is uncorrelated to economic recovery and growth. Therefore, the impact is expected to be relatively smaller. The Fed actions will spur central banks around the globe, including RBI, to adjust their own policy stance to balance the demands of local macroeconomic factors.
Against this backdrop, investors should expect a choppy session on Friday as well. FPI activity, outcome of the monetary policy meeting of Bank of Japan, and general global sentiment will be the key drivers today. Back home, initial public offers, stock-specific action, FTSE rebalancing, and rejig of Sensex components will also guide the indices.
Moving on from the US economy, let's see what is happening on the technological front in India. The country is currently testing 5G network services ahead of the final rollout sometime next year. Interestingly, India is simultaneously working towards developing the next generation of communication technology called 6G using indigenously developed infrastructure. The aim is to launch it either by the end of 2023 or by early 2024. But what is 6G? How would it be different from 5G? Let's find out.
We have come a long way from using networks for telephony services, such as calls and messages in 2G, experiencing broadband speed in 3G, deploying private office networks in 4G, to now setting up smart spaces using automation and robotics in 5G. Each successive generation of communication technology brings about significant changes in the network, perfecting the use cases of the previous generation and introducing new ones. While 5G is still at its nascent stage, 6G will build on top of 5G. It is touted to drive the adoption of 5G use cases at scale through optimizations and cost reduction, especially at the enterprise level. At the same time, it will enable new use cases. Moreover, 6G will bring together the human, physical, and virtual environments. Take the concept of metaverse for example. It is one of the 5G use cases which promises to disrupt both traditional and digital spaces. With 6G, the metaverse would not just evolve into a final model, but is also likely to unify with the physical world with the help of artificial intelligence and machine learning. This is because the most notable aspect of 6G would be its ability to sense the environment, people, and objects, according to telecom gear maker Nokia Bell Labs. The network's sensing ability combined with artificial intelligence and machine learning will make the network more cognitive. India is running behind schedule on the rollout of 5G, but tables may turn with 6G. This is because the country has already begun the development of 6G. According to Minister of Communication Ashwini Vaishnaw, work towards developing the next generation of communication technology has begun using indigenously developed 6G infrastructure with the aim to launch it either by 2023 end or early 2024.
From 2G to 4G, the world has taken a leap of faith in technology. Data has never traveled as fast as it does now. Now 5G and 6G will only take things forward. With that, it's a wrap on the show. We'll be back tomorrow morning with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.